The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we track the midweek market action, some general positivity in the grain and livestock sector led by the row crops and the cattle complex on the day Wednesday. How are these markets looking as we begin the new month of June? Looking at the technical picture, charts, weather, and much more. Let's talk about it. Joining us, Mike Zuzolo, Global Commodity Analytics. Mike, good to talk with you again here this week, my friend. And I'll say again, some general positivity in the market trade here at midweek.
Yeah, I really liked how the day on Wednesday finished, except for the corn market and the weakness in the spread, which we can get to in a minute. But I really do want this trade to stick to the program of the worsening conditions on the weather front and put wheat out there as the leader to the upside, not so much the soybeans, mainly because of the weather and the drop in prices in the wheat market. You know, we are just now coming off of some pretty significant lows in the wheat market, Jesse. And yeah, while the crop conditions did get better and improve in both spring wheat and winter wheat this week, we still have a lot of problems globally. So I see this toggling on and off of the trade going, okay, let's trade U.S. weather or let's trade global weather. And it seemed like by the time we got to Wednesday's trade, with the beans pulling back towards the lower end of their range and the wheat staying at the upper end of their range, even with corn fighting it, and the corn being mostly weak in the front end especially, it seems like we're taking into consideration more that weaker dollar and the global weather.
Well, let's talk about the global weather picture here a little bit more. I think some of what we're seeing in the U.S. is maybe, we've talked about it a lot. It's well known, but what about some of the issues in China right now? How much is that possibly impacting the markets and maybe giving us some weather premium, Mike?
Yeah, I mean, I don't think we've got hardly any weather premium in right now because China is such a large producer of wheat. I mean, USDA have them at 142 million metric tons for the wheat crop this year for 25-26. That compares to just over 140 last year. That puts them at about a 6 million ton import forecast for this year versus 3.3 last year. But they are such a large player right there with the Europeans and the United States that if they have a substantial problem, we could be talking about 20, 30, maybe even 40 million metric tons of production. And the reason I'm throwing that kind of a number out, Jesse, is because of these maps. I mean, what I highlighted on the right-hand side is the drought intensity. In other words, the soil moisture levels from 0 to 100 centimeters, what we're looking at as far as soil moisture versus normal. And as you get into the deep dark reds, that's essentially 0 and going all the way down 100 centimeters. And if you look at that blue circle and compare that to the green areas of the USDA shadings by province of wheat production, you are literally talking about 50% of the crop production plus that is in a significant drought. Now, here's the kicker. The right-hand map, that drought intensity map, that's a week away. That's 7 days away from you and I talking. And so what we're talking about here is actually worsening conditions in China in their main wheat belt over the next 7 days. And I think this is going to really speed up their harvest progress and probably put the kind of nails in the coffin for them to be able to resume any kind of production improvement after this next week, because they're going back up into the mid to upper 90s with next to no precipitation in Henan province, especially, and Hubei province as well. And those two together end up being about 40% typically of wheat production.
Let's take a look at the monthly SRW chart. Now, I'll make a comment here about U.S. weather as well. On top of all of this is that obviously we've had, various issues too wet in the eastern belt. We've gotten some beneficial moisture out in the plains, yet there's still a lot of that talk about a hotter, drier forecast here later this month into the summer and more. And we started out with some initial wheat ratings, I know, that weren't the best here. Even though we've seen a bit of an uptick on the spring wheat ratings. But I mean, just bringing U.S. weather into the conversation here a little bit more and looking at this monthly SRW chart, I mean, are we starting to see all of this weather premium kind of combine here, Mike?
Yeah, I think that's what I'm trying to get at. I think you're seeing what I'm seeing right now in terms of the fundamentals and the possibilities of the chart. And going to your point directly, you reminded me that I talked to a client and another media contact in South Central Kansas, and the client was in Sedgwick County, which is Wichita, Kansas. And it's usually the number 2, 3, 4 county in the whole state of Kansas for winter wheat production. Very big driver of the state yield. And I've heard, and he confirmed, that there is some pretty bad wheat laying flat. Now, they don't think it's going to be permanently damaged. But having said that, I'm actually worried more about too much rain here in the next 20 to 30 days as harvesters and combines want to get rolling, and disease pressure, could really start to spike. So I think this is a real key to the U.S. crop, maybe not this week, but next week. If these big rains along the Kansas-Oklahoma border manifest themselves, the U.S. crop may become more of a bullish feature as opposed to the best thing out there in terms of the Northern Hemisphere. I'm not talking anything about Ukraine and Russia. Russia is actually as bad, if not worse, than China in terms of Western Russia wheat potential. But yeah, this chart really kind of shows several things that I'm going to be on the lookout for as the month of June progresses. We've got the blue trend line that keeps us off of the buy signal or the upside potential. That trend line's drawn off the highs from 2024. Also the highs from late 2025. If you notice the price action from last month, we got down below $5, right around $4.99. The major low from 2024 was $4.93.5. That May low that we just put in could be a test, could be considered a test of the major lows and the bottom end of the market, because that low from mid 2024 was a 3+ year low going all the way back to 2020. So if we break above the blue trend line of resistance, that may confirm us as having a low in place for 1 to maybe 4 months would be my guess, Jesse. And that's based upon that white and purple line down at the bottom, the stochastic oscillator starting to try and give its first good buy signal since the early part of 2025 and later part of 2024. So I'm trying to put the technicals and fundamentals together, along with that weaker dollar still down near its 3-year low as we closed up Wednesday's market price action.
We talk about weather impacts here, U.S. and global. On the wheat side of this, let's go over to the soy complex and let's talk about what you are seeing there as we begin the month of June. And maybe, are we starting to get some seasonality weather premium on the soybean side? Let's talk about that and look at the November seasonal chart here to get us started with the soy complex.
I do think the trade is more worried about the soybean and corn here in the United States because of the crop conditions for both being 67% good to excellent. That's substantially below in corn versus the 10-year average. I think it's about 3 points below the 10-year average in beans, if I remember right. The key here, I think, is we continue to see and feel the tariff pressure, the tariff gas pedal, the tariff brake. And what I mean by that is when the trade tariffs and the outlook looks better between the U.S. and China, or the U.S. and even India, another huge potential trade agreement that would really help us dramatically, especially if things don't come around with China. The soybeans win when the trade outlook improves. And the discussion that President Trump and President Xi were going to talk at the later end of this week really turned the market, especially with those crop conditions not looking so good. But then by the same token, when we see the dollar weakening and we see the trade outlook getting worse, that tends to help the wheat market as the fears for the trade wars go up. And so I think what the trade's gotten used to, quite frankly, is buying wheat and selling beans when the trade fears increase and the dollar goes down, gold goes up, and doing the exact opposite when we see the opposite meaning and sentiment when it comes to the trade fears. And so I'm very nervous still about the trade fears and trade issues between the U.S. and China. And I think that it actually could be better at this point to get a deal with India, because I'm more nervous we won't get a deal with China. And I say that because the U.S. steel tariffs that we increased, that was a very big deal to China. They are about 25%, or last year were about 25% of all global exports of steel in the world. And then the crackdown on the Chinese student visas that we put in place late last week, early this week, I've gotten from several sources that is a kind of a humiliating feature to the Chinese government, and they're very unhappy about that. So when I bake all this into the cake, it goes back to what we talked about last week. Okay, are we on track for either a 2009 price action or a 2018 price action in November beans? And that purple line, which I forgot to highlight, is 2018. And so we're still very much on track with the 2018 price action. What would pull us out of that 2018 price action? A trade deal with China, watching the meal, and then obviously what I would really like to see is the wheat and corn say, no soybeans, you're not going lower right now. We got other plans.
We're having a conversation here today on Market Talk with Mike Zuzolo from Global Commodity Analytics. What about the world picture here? And, you mentioned the trade deals and the India one. I agree with you. I think there's maybe some more hope to get that and have that be a boost for U.S. ag products versus what we could end up with here with China. But thinking about, the Brazil role here in the soybean industry, of course, with China and more, and you look at the world prices right now between Brazil, Argentina, U.S. beans, etc. What stands out to you when you look at the soybean complex on the global scale more, Mike?
Yeah, with the WASDE report, the next one coming around on I believe it's the 10th of June, if I remember right. It's going to be, I think it's around the 10th of June. With that coming around, I think we need to really keep our eyes on the world prices. And as you see by this, Jesse, we are seeing Brazil's prices go down now after having hit a high about a week or two ago. The green and dark purple are the U.S. soybean prices, both at the Gulf of Mexico and the Pacific Northwest. And so you see the Argentine price well below both Brazil and the U.S. And now Brazil's starting to go down as well. The second thing we really have to keep looking at when it comes to the world picture and the soybean side of the equation is the bean oil and the crude oil relationship. And then that also matched up with what will the USDA WASDE report say? Will we be still at 169, or will we go back up towards a 170 million metric ton Brazilian bean crop? And I just can't get away from the issue that we are dealing with world record high ending stocks in soybeans. And so those are the main things that drive my fundamentals, along with the fact that when I check every day the crush margins for China in their key crushing provinces like Shandong province, those margins are negative right now. So they're going to buy the cheapest beans if they're going to buy right now. But right now their margins are negative, and that would indicate that their demand, their import buying demand is going to be relatively subdued at this point.
Let's give some thoughts to corn before we move over to the livestock trade. Let's talk December corn. There's still, I think, maybe some old crop out there, but I think a lot of the focus in this market has rolled to this new crop December contract and beyond. And to me, these corn, and really the corn market in general, has just been very choppy to sideways, even lower here as of late. I mean, what are you tracking in this corn complex, Mike?
Very concerning. I agree with you wholeheartedly, especially the July D's corn spread. On Wednesday, that spread worsened, even though we've got bullish fundamentals of very strong ethanol demand again this past week, which registered on Wednesday's report. The export inspections on Monday, very strong again, 1.5 million metric tons, still keeping us up 29-30% year to date on inspections versus last year. But that July D's corn spread went down to a nickel discount to the July, or a nickel premium to the December. It's back to a carrying charge market, which typically is a demand-led spread, Jesse. It would suggest we don't have enough demand to meet the supply, and we're back to paying producers to store new crop or store old crop all the way into new crop potentially. This just flies in the face of the fundamentals right now, unless it's solely based upon one of two things. And by the way, that -5 close was the lowest since I think mid-October of 2024. So it's really down there. But two things I think that this Dees corn may be showing us with a potential buy signal in the stochastics breaking above the trend line is what we talked about earlier about the crop conditions and whether we're going to get the corn off to a good enough start to match up with that 181 yield. Is the trade coming in and buying Dees and selling July as a short-term play? The second thing it could be is that the Brazilian corn crop estimates have been going up much more rapidly on private estimates here this week ahead of the report next week than the soybeans. I mean, I've seen one as high as 134 million metric tons. That would be near or at a new record yield on an already acreage base that's a record. That 134 compares to USDA's May number of 131. But at the end of this week, I want that July Dees back up above premium in the July, or I'm going to have some real issues to contend with.
All right, Mike, let's talk livestock. And I was going to ask you here, the way some of this cattle action has been the last few sessions, I was wondering, are we getting a little tired finally in the cattle trade? Yet you look at futures Wednesday and both fats and feeders, and we had a really solid day to the upside. So starting with the feeder chart, as you're looking at this maybe from a cycle perspective, I mean, compared back to last time we saw some of these levels, 2014-ish, et cetera. I mean, what are you tracking right now? When are we going to get tired potentially in this cattle complex?
Yeah, great question. I think the Tuesday price action was a wake-up call because we did see that outside day and the feeders led the declines. And I don't know if there was another rumor out there about screwworm or whether it had to do with the CME widening the limits, and that moved the computer pricing and computer price action and trading into a different gear. I think those are the two best likelihoods, but the key was not to have that kind of follow through to the downside on Wednesday, or we did need to probably have to get serious about getting those hedges in place for the rest of Q2 and all of Q3, which I still plan to do by this Friday, as long as we're rallying still. But yeah, the cycle activity in both feeders and fats would suggest that we are pushing up against the string. We need new information to feed the bull. And I think that the new news coming out on Wednesday about the U.S. and Mexico sitting down in Mexico City and talking technicals about the screwworm issue and getting the border open back up. I think between that and my nervousness about the trade issue and the resumption of Wall Street going down again, I think you really need to be ready to get those hedges in place. And like we talked about last week, I think, like soybeans, I just want to do bought puts in the cattle so I can manage my risk and be in real time and be able to pull those positions off if I'm wrong. But if we fall into a sinkhole like I'm worried about in the beans in 2018, and we see the border opens back up again, I need to have those positions on before that would be announced as opposed to afterwards. And that's why I'm going ahead and doing what I'm doing. But this cycle in orange really does show that 2013 cycle low in back in the very beginning of this chart, and the next cycle low was 2020. It would make sense that the next cycle low coming would be around that 2027 time period. So that 7-year cycle shows up really nicely, and those trend lines I think are good guides in this feeder cattle market.
Something to keep an eye on, no doubt. A great analysis there. What about boxed beef and some of the comparisons there? We've been tracking that and the retail demand and more. What's tracking for you when you compare boxed beef with live cattle futures this week?
Well, we've gotten that boxed beef price up to levels not seen since the pandemic. And I would say that should be kind of a historic high just because of the nature of what we went through during that time period. And so we are banging on that door. That has been a target of mine. I've got other price targets as well in other categories as well, Jesse, but we are hitting now a major price target in that choice box beef. And as we've talked about, seasonally, it gets a lot harder for box beef to go higher. And I think this year is going to be more of a seasonal year just because of how hard it's going to be to cash flow and afford the beef this summer grilling season. So now we did make the new record high in feeders. We are trying to make new record highs again and take out the May highs in fat cattle. This is, I think, a great opportunity to get those puts bought on a rally and in record price levels. Notice on the cycle chart here, it's a 4-year cycle. Again, it's got a pretty good look to it. And even though we had a big cycle shift and, even with the pandemic, those cycles still held up fairly well. And so this would suggest, once again, on a 4-year basis, if our last cycle low was mid-2023, it would be mid-2027. So it's neat to see how a 7-year cycle on feeders and a 4-year cycle, 3.5-year cycle on fats really match up well with one another.
Any notes of the hog trade, Mike, before we wrap it up here today? A somewhat okay day, I'd say, on Wednesday, but are we getting a little tired here at some of these price levels above 105 July on Wednesday's close, for instance?
Yeah, I think so. I think the hogs got that extra boost with more Chinese purchases on the pork export sales. I'd be looking at that Thursday real closely. Pork and beans are what I'm looking at most on the export sales reports on Thursdays, Jesse, for any leading indicators, what I would call high frequency, indicators or data. If we start to see more cancellations in beans by China, or if we see China continue to buy hogs, then the hog market at the mid 100s could be sustained for the summer market for a couple more weeks.
Any other final thoughts for us, Mike, before we close it out today?
Yeah, still got the dollar breaking lower. That's really good news. That keeps, I think, the funds at bay from wanting to sell this market. But the more this market goes into the summertime, Jesse, it seems to me with U.S. weather straightening out for row crops, it's really up to the wheat to turn the market higher.
Mike, if folks want to reach out to you, take a look at your analysis and much more, what's the best way?
Best places to go is globalcomresearch.com and sign up for a 2-week free trial. You only have to answer 3 questions and we get it started.
Fantastic. Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Have a great week. We'll talk to you next week.
Thanks, Jesse. You too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.